Good evening, everyone. On a day when the RBI has hiked rates, we are going to do this in two parts. First, I will give my view of whatever has happened. We'll be writing more about this, but I just wanted to get an idea of what other people think of what has happened so far. And also, if you have any questions, it will help us kind of understand what the impact of this might be overall. Stock markets, bond markets, mutual funds, whatever. And, then we can take it from there. So, first, I'll just talk solo. And if anybody wants to ask a question, please raise your hand. I will add you as speakers, and then we can take it from there. So, I hope everyone can hear me clearly. Um, Actually, I need somebody to tell me they can hear me. But if you can't, uh, let me know. At least it seems to be okay here. Um, so, all out of the blue, EC members who got together and said, listen, we need an emergency rate increase. Now, why that should happen now, out of the blue, lots of questions around it, but we'll come to what has happened first. Interest rates from a repo perspective, which means the rate at which the RBI lends to banks, has gone up to 4.4 for 4%. Last time rates were changed was probably a year back, and they were all on a decreasing interest rate cycle. Now we have an increasing interest rate cycle. So interest is the first time we've raised rates for a long time now. The last time I think rates were raised was sometime after demonetization or something like that, 2018 maybe. Rate hike of 40 basis the next time. So they'll, instead of doing 50 and 25, they do 40 and 35. So it's just an easing off effect. Clearly, they have RBI has mentioned that they are changing their stance from what is called accommodative, where they will say, listen, we won't raise rates, but we won't drop rates also, and we will keep the money supply flowing and all that stuff, to I want to actually curb money supply. Now, why are they doing this? Is because inflation is a problem worldwide, with rates having gone to um, rates having gone to approximately 5.37% inflation in the consumer price index side. Wholesale price indexes are even higher. Food, whether it is on vegetable oils, petrol, and therefore downstream related activities. Now, this impacts a lot of things. Uh, Inflation has been traditionally thought to be supply led, saying, okay, well, it seems like Ukraine war, it seems like China's COVID issues, therefore it's relatively moderate. I still agree with that. I think inflation for India is primarily because of these factors, which are relatively temporary in nature, and they will kind of improve. So I don't think oil prices will sustain above 100 for a long time, especially when interest rates worldwide are going up. And I also don't think China will lock down under COVID for so long that supply side issues continue to exist for a much longer time. So I think India will see a different economic reality in terms of inflation. One of the reasons why inflation is higher now is because last year, approximately at this time, India was under the worst effect of COVID. So India had slowed down considerably from earlier. So a lot of the prices and all that stuff, the difference in inflation has been coming because of various lockdowns and issues related to lockdowns. It was in April 2021, March, April, May. So if you see the inflation data of last year, the index was flat, more or less flat between, say, March and June. In June, when the lockdown started to open, on July onwards, we saw rising inflationary index. That means the consumer price index kept rising after July. So if you look at that base, then inflation index is rising right now. It is rising against what was a flat index last year. So April, May, June will look high. Even the RBI has admitted that even before this, even in the April policy, they actually said, listen, we expect inflation to go up simply because of the base effect. Now also they continue to admit that. However, they think that the issues are more persistent than temporary. Therefore, the rate hikes are coming. The rate hikes are also coming because of the West. The West has substantially increased rates. They're seeing much higher inflation. Now, the West, according to me, has higher inflation because of a different reason entirely. The reason is, in my view, that the governments there see inflation doesn't happen when Fed prints money. The Fed printing money has very little consequence if when it prints money, the money does not then get loaned by banks to the public. Only time when inflation comes is when the public has more money to spend. If you print money and the banks then park the excess money back with RBI or with the Fed, there's no inflation. We saw that for 9 years in the US or 10 years in the US between 2009 and 2019 or 20. Um, in India also, there's been a lot of money printing in the last 6 or 7 years after demonetization, everything all happened. That has not resulted in extremely high inflation ever till now. So what has changed now is that in the last 2 years, the Western economies have printed a very large amount of money to give as free money to public. Whether it was, oh, here's a monthly income, even if you don't have COVID or if you're not affected, I'll still give you money. The US gave $600 or $2,400 per month to every American that qualified. For about 12 to 14 months, they got this free money. This free money was in the hands of people, and that is what causes inflation. It causes inflation in different ways. People who get that money say, "I don't want to work because if I'm paid for free, then why should I bother working?" So it increases the cost of hiring people who otherwise would have charged lesser, but now they get a pricing power, so they can charge more. Wages are one, rents are another. People use that money to buy houses or bid for hire for houses, pay higher rents, and so on. So there is a inflationary impact of printing money to give to the general public, and that inflation is playing out in the West. So they will have persistent inflation, but India is likely to have more temporary because we didn't print money to give to people. People in India did not get much money from or any money at all. In any meaningful way. So I think from that perspective, we should be temporary. However, this has happened. So what we should say is what are they saying? They're saying clearly we are going to increase rates. It's all looking likely that another rate increase will happen in June and another rate increase will happen in July also because inflation will continue to be high. And the first time that we might see negative, a pause in rising is only in August, according to me, which is when um, the base effect goes away and you get some impact of um, the current rate rises. So what do rate rises do? Even if it's supply led, what they do is they curb demand. When you increase interest rates, people will not be able to borrow to do things like buy houses or buy things on credit or for companies to do capex. Therefore, demand in the economy comes down. So supply is anyway low because of China and issues with respect to shipping and issues with respect to Russia, Ukraine, and so on. If you curb demand, that will then also bring down inflation. So curbing demand is it's like hitting, I don't know, using a sledgehammer to kill a fly. It will destroy a lot more things than just the fly. So, but it is the weapon that the central banks have. The government can ease inflation very easily by reducing the amount that it charges as tax on fuels. If it were to do that, it would reduce inflation. But I don't think the government really wants to do that because it destroys their own finances. But more importantly, it's free money for them. Nobody likes to give away, give back money that they're getting for free. So there is a resistance to doing that. So it will only happen if the economy goes into a recession when the government will actually ease up on the taxes. The other thing the government has done, the RBI has done, is increase the cash reserve ratio by 0.5%. Now, I'll tell you what the impact of this is for the banking system. Banking system has currently about 5.7 to 5.8 lakh crores extra lying around with them. It means this is money that RBI has created, which has cities, which banks just park back with the RBI every day. So they don't borrow from the RBI; they lend to the RBI. So increasing the repo rate to 4.4 does not increase the cost level for banks. What it does is, on the 5.75 lakh crores, 575,000 crores that they have extra, they used to get a certain interest. Now that interest was a rate. There are two rates for it. Uh, One is the SDF, which is a daily thing where the RBI, I mean, the banks can say, listen, I got this extra money, give me some. What do you want to give me on it? And that's 3.75%, what the RBI used to give. Now, that's also been increased by 40 basis points. So it becomes 4.15%. 4.15% means 40 basis points increases quite a bit. You can imagine on a whole year. That's about well, on 5,75,000 crores, it will be of the order of what is it? 40 basis 2,000 crores. 2,000 crores is the profit that the banking system will incrementally make higher in the next 1 year because they can get more on that money by 40 basis points. Now, there's another way, there's something called VRRR, variable rate reverse repo. Variable rate reverse repo is when the banks bid to place money with the RBI for a longer period, not just overnight, which is what the SDF is. But, uh, the variable rate reverse repo is at 3.99. Essentially, it's repo minus 0.01%. So people bid at for to put money with the RBI. The RBI says, "Well, fine, I'll take it. Tell me how much you want for it," and people can bid all the way up to 3.99%. That was till today. Till tomorrow, they will be able to bid till 4.4%. So they will get 4.39% on that money, depending on how many VRRRs are conducted and all that stuff. So essentially, it increases the return profile for banks on this money that was excess lying around with them. However, there is an increase in CRR. So CRR is another thing that the banks have to give to the RBI. But this other thing banks have to give for no interest at all. Cash reserve ratio. That is currently 4% of their total deposits. 4% of their total deposits currently adds up to about 6,76,000 crores. So they give 6,76,000 crores to the RBI for no return at all, and then this other 5,75,000 crores they give it for this 4 to 4.4% uh, uh, per year. With the change in CRR, they will have to give another 87,000 crores extra to the RBI for no return at all. That means what 87,000 crores today was earning some 4% at least, tomorrow it will earn nothing. So banks net will probably see no impact, major impact, net impact of this rise in interest rates. Their income will go up, but some of the money they have to increase, which they have to give cash free to the RBI. So net negates the two. So the bank's cost of funds does not necessarily go up. In fact, almost remains the same for the near term. So right now, I don't think there's a major impact of this change. However, it's clear that the RBI is going to keep increasing rates, possibly increasing CRR, but we don't know. CRR has been constant for the longest time. This does impact a lot of things. I'll quickly enumerate and then we'll take questions. It impacts your long-term bond mutual funds, specifically government bonds. In the beginning, government bond yields have gone from 7.15% yesterday to 7.37% today. This is a 1.5. So if you had bought something for 100 rupees today, tomorrow it will be worth 98 rupees 50 paisa. 1.5% it has fallen. 1 rupee 50 paisa it has fallen. So every of your long-term bond funds will at least fall down by 1.5%, more or less. This means then there's an impact to bond funds, and given that the RBI is going to increase rates, you might think that there will be a higher impact even in the days to come. However, I have one thing to say here. The near-term interest rate, that means the overnight interest rate, is at 4%. That means nobody can easily borrow below 4% in this economy for the most part. Some people do, but let's leave that alone. At 4%, if you can borrow for the short term, how much does it cost you to borrow for 10 years? Is at least the government 10-year bond yield, which was 7.15. So the difference between the two, 4 and 7.15, 3.15%. This spread is one of the largest in history. Even today, 7.4 versus, 7.37% is the 10-year, and overnight will become 4.4. It's still a very large difference, 3%. I expect that spread should come down to 2%. That means long term should be able to borrow for 2% more than the short term. That's my theory around it. I expect that the RBI will raise yield, raise rate at least till 5% before see inflation coming down. So even if you assume that they can raise all the way to 6% for repo, I expect 10-year yields to be of the order of 8% because there's a 2% higher spread on that. So we are at 7.37, 7.37 to 8 is not so bad. So some of the longer term bond funds, while they've already seen a hit today, I hope I can see. Okay. So yeah, here we are. I'm sorry, I know there were requests, but I couldn't add you on at that time. So longer term, um, rates on the long bond may not go so badly from the government side. However, in a rate rising cycle, corporate bonds um, tend to see a bigger hit, which is the difference between a 10-year bond borrowed by the government, which is 7.37%, versus a 10-year bond borrowed by, let's say, HDFC. It used to be very small, it used to be only 0.2% higher. Now that will change because in a rising interest rate, what is called the AAA bond spread with the government, that spread widens, it increases. So I expect corporate bonds to perform much worse than government bonds in the days coming forward. So you should be careful of long-term corporate bond and corporate bond funds. Um, the shorter term, only floaters will do well. So anything below 1 year, around 1 to 1.5 years to maturity, that won't get very badly affected. Anything between, say, 2 years to 6, 7, 8 years, that is going to be the worst affected because short term rates are going to rise. And the short term rates currently, like I said, are 4%. Even 1 year is about 5.5. 2 year is about 5.75. All those will rise to above 6.5. At least 1 year, 1.5 years kind of thing. 6% may happen. So we are likely to see a lot of damage in uh, uh, shorter term bond funds. So they call short term bond funds, and even in the short term bonds that if you own them directly. On equity markets, of course, there will be an impact, but we'll see how bad that impact is. That impact has much more to do with worldwide rates than to do with Indian rates. And worldwide, the situation is quite bad. So we might see more damage in the equity markets, though you cannot predict. Okay, sometimes equity markets read more into news than we have available information on. So they might have already, you know, started the descent even before this, and then it may just continue for a while longer. Right? I mean, I don't know. So the answer to equity markets we'll have to see, but you have to be careful to understand what is going to get impacted. Anyone with a very large amount of debt and without a lot of cash to compensate, those are companies that will get impacted quite heavily in this because you may not be able to raise output prices so much, but your cost of funds has increased literally overnight to night. So, and other thing to watch out for is NBFCs because I think NBFCs are going to get seriously damaged when interest rates go up. Every single time that RBI has raised rates or started a rate raising cycle, it is NBFCs who have taken the brunt of the damage. So you should be careful about those as a sector. But now I'll take questions so that we just stop droning on. Okay, here we go. Please go ahead, request your questions. I don't know why I can't see. Okay, okay. There you go. So, questions, please remember that if you're asking a question, I'll call out your name before your question is asked, and I will also very quickly request you to keep your question short, but also to not ask any stock specific questions because that's not useful. Okay, let's see if we can get more people to answer or request. While the queue builds up, um, let me ask you guys this to think about. is uh, what do you think happens to um, corporate, sorry, to equity markets? Okay, sorry. Equity markets in case the Fed raises by 50 basis points today. Tonight, I think, is when the Fed is going to raise. By the way, that's another question. Have they raised fund? Have they raised uh, rates in advance of what the new Fed is going to do? Uh, I would imagine that to a very large extent we don't have. Okay, here you go. We've got a request. Speaker. We have Prashant who's here. Prashant, go ahead. Yeah, your view, your call.
Am I audible, Deepak?
Yes,
Yeah.
please. Yes, yes. I hope I am audible.
Yes,
No? I
yes,
don't know
you
if
are.
I am.
Okay. Deepak, you mentioned that, whenever there's interest rate hike, equities kind of underperform. But the last time I'm talking about the 2003 to 8 cycle, when interest rates kind of moved up dramatically, we've had the biggest bull run during that cycle. Uh, what makes you think that this time will be different? With growth also expected to go out.
Actually, yeah, no, no. So to be clear, I don't think that interest rates going up will impact equity markets like this. In the sense, I haven't said that. I don't know whether that's not a universal statement. So the way it affects equity markets has a bearing on whether um, there is this the sentiment is that RBI is trying to control growth or inflation. So when I say that the difference between what happened in 2010, 2011, 2012 was that when RBI, in the 2013 also, the RBI raised rates. When the RBI raised rates the cycle started in 2013 once when Rajan came in and he raised rates. That time the equity markets recovered when he raised rates, mostly because they'd already taken the brunt of the damage earlier. And there was a massive rupee crisis. This time there is no rupee crisis at all. In the sense, the rupee is actually rock solid right now. Even today it was up 8 paisa or 10 paisa or something like that. Up, that means it is not down. So it was the exact. Before this also, even though other currencies have been hurting, India's currency has been rock solid the last, I think, 6 to 7 months. Even though cost of fuel, everything, and all have gone up, our currency has been rock solid and stable. So I don't think it's the same as the rate raising cycle of the 2013 time frame. Because at that time the rate hike brought in more stability and then there was a taper tantrum also at that time, but that brought stability into the Indian macroeconomic part. Here we're already sitting with a fairly stable macroeconomic situation, so the rate raise is likely to deter sentiment in equities, just the way it is right now. In the 2002 to 2007 or 8 cycle, inflation was running very high in comparison, and the RBI was doing a very different thing. That time the system was not in a surplus, it was in a deficit. Banks were borrowing overnight from the RBI. So every rupee that the RBI printed, and it printed a lot of rupees to buy the dollars that were coming in. They wanted the dollar to appreciate. And therefore they were buying so many dollars that they were printing money left, right, and center just to buy those dollars. So the money supply was going to the banks. The banks were then lending out all of that money to the public. So our money supply was increasing massively. So when they were raising rates, it was to control growth, not to, uh, you know, not because there was a supply side issue at all. Most of the issues were demand led, and you're trying to control demand. And when demand is very high, the equity markets tend to get buoyant because they're saying, well, listen, as long as this layer of inflation is the economic growth can support it, then that's fine. Today, it's a very different world. Credit growth is at 8%, which is, in fact, now it's reaching. It was 6% 2 months ago. It's one of the reasons, there is no growth is because banks are not lending out. So I don't think this time, I think this time we're in an inverted situation. Banks are not borrowing from the RBI, they're not giving out credit, and now you're raising rates. which will make credit even less attractive. But but essentially what you're trying to do is whatever little demand is there, crush that also, because supply has a bigger problem. This is why I think equity markets will get affected very differently this time compared to 2002 to 2008.
Understood. Thanks so much, Deepak.
Thanks, right, Krishan? Uh, okay. If anybody else has a question, please go ahead. Um, Meanwhile, let me add one more thing here. There are certain products like bond ETFs in the market. There is a problem in those bond ETFs, especially Bharat bond. You don't know what the current NAV is and current yields are. Okay? The yield given on the Bharat bond information page is outdated substantially. So if you go there, you will actually go when you see the Bharat bond web page, you might actually see that the yield is 7.29%. It's not. It's actually 7.65 or 7.7% already today because the Bharat bond website is outdated. It's wrong. So unfortunately, it's a little bit out of syllabus for me to tell you guys how to calculate yield and all that. But please note that that is incorrect representation of what the yield actually is. In fact, they updated the price of the NAV of the fund at 3 p.m. So 2:45, the NAV was showing 998, and the 2032 bond was showing 998. At 3 p.m. they updated it; it became 984. So it had lost 1.5% at the time, but it had already lost it as soon as the RBI had governor started to talk. Yields in the market had moved up already. So if you are a bond ETF buyer, you have to be careful. Sorry, we have Elron here. I will allow him to speak.
Yeah, hi. My question is no, very simple one. So, do you think that this move will get the market a little bit panicky? Because when people panic, we can buy some good shares at lower cost. So, do you think the panic will spread in some coming months, or it will be just one of those events, which is a non-starter or not a big event? Let's say 1 month down the line.
Okay, so the correct way to answer this question is always say that something big will happen. Because there is no guarantee. Nobody knows. At best, you are trying to make a prediction of 50-50. You might as well predict the worst thing because if it happens, you get hailed like a hero. If you don't, if nothing happens, then people say, ha ha, whatever, how would he have known? So there's no downside to predicting a big thing. But I mean, it's just that there's no point predicting, but it's better to react to what is happening. There is already panic. It's not like there's no panic. There is panic happening in many stocks. Some stocks are down 6, 7, 8% on this news. Companies which don't have debt also, which don't have anything to do with debt also, are panicking on. I mean, I've seen some false sales. This is just the way markets are. There will always be some panic, some drama somewhere. I don't think you will have a lack of opportunities if you are a buyer or a lack of opportunities to sell if you're a seller. There will always be that. So keep a watch for opportunities when they come. In general, to predict a panic is like a once in a lifetime thing. So if you're asking me seriously and if you're going to chopify my answer in some place, please say Deepak Chuna predicted big fall because there's no downside to that, right? Predicted big fall में अगर नहीं होता है तो nobody remembers. So, but in general, I
Correct.
say I don't think anybody knows.
Correct. Correct.
Yeah,
Correct.
even if they say they know, nobody knows.
Yes, you're right. And what do you think will be the impact on this SBI's gold bonds, the RBI's gold bond, which give 2% interest? Do you think there also people, will panic and it will go down so that it gives us an opportunity to buy it, in panic?
So, okay, let me ask you this: what is the yield you currently get on those bonds?
It is 2.5%, I think. Yes, 2.5%.
It is not because those bonds are trading 10% below the value of gold. So your
Okay.
actual yield is higher, no?
Yes, you're right. So
So,
that means more
correct.
profit is coming down the line. Like because tomorrow or day after tomorrow, in 5 3 days, people will start to panic
No,
there
no.
also, correct? Because 2.5%
I,
is
I,
nothing.
I'm not saying that. I'm saying that they've already panicked years back. These bonds have been trading at a 10% discount to the gold price even 1 year ago when there was no
Okay.
interest rate problem. So there was
Okay.
panic already. I don't know whether we call it panic or not, but price.
Mm-hmm.
Why do you get an instrument that pays you interest? and is linked to the gold price, trading 10% below the gold price. When buying
Mm-hmm.
actual gold has a 3% GST,
Correct.
plus it does not pay you any interest.
Mm-hmm.
So technically they should be trading at a premium, but they are trading at a 10% discount. That means panic was already there. तो इस न्यूज से कोई फर्क नहीं पड़ेगा.
Correct. Correct.
And gold is not a great instrument for me anyways. I don't like it. So I think even buying a SGB is like losing money. So
Mm-hmm.
because principal
Okay.
तो guaranteed नहीं है
Correct. 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 You're
in
right.
a
Yes.
gold bond. Yeah.
Yes. You're right.
So
Okay. Thank you. That's it from my side. Thanks for this.
thanks a lot.
Thank you for such a
Thank
generous,
you.
session of knowledge sharing. Thank you.
Not at all. Achha, we'll write more. I'd love to hear more questions, thoughts, anyone who wants to talk about. By the way, one of the things that you have to be careful about is if you're buying risky debt instruments of any sort, that risk can be much worse than you imagined in the sense that Edelweiss bonds, for instance, were already trading at 10%, 11%. I've seen them go to 12, 13%. Indiabulls housing finance bonds were trading at 10, 11%. I've seen them go to 19%. You can see that anything that has a inkling of a feeling कि ये weak company, weak NBFC, they will see their bonds trade at much, much lower yields. So you should be able to get, uh, you should be very careful of these um, higher yield and lower quality bonds in general. And this is a very bad time to be invested in them because you will find that some of these bonds will give you heartache if you've got a lot of money invested in them. If you're taking some chota mota risk, it's okay. But if you're putting serious money behind high risk, illiquid bonds of companies that are not the the best, whether it's an NBFC, whether it's a company that's borrowing, I think you should be careful about that. And whether we see defaults or not, I don't know. I mean, even Russia can default right now, but I do think that you should be careful. Sharad Bhai is here. I will allow him to take it, sir. Hello, Sharad Bhai, are you there? I think he can't hear, or I can't hear him. Uh, okay. So we have that. Okay, one of the reasons why I said things about the bond universe is, in general, you see, the pressures on bonds tend to come and hurt a lot of people who are who don't know what they're buying. So, for instance, I can buy a PFC bond, bond from a market which is even tax free. The tax free yields have gone up to 4.5, maybe even 5%. So you can buy a tax free bond at 5%. But at PFC, I'm not so worried. REC, I'm not so worried. But some chota mota, like say, or even for instance, in Edelweiss, I am worried. I don't know why the market is trading their bonds at 12%. I don't know why their market is trading some. And if you to notice today, what has happened in the bond market, a substantial number of bonds have gone into trade at ridiculously high yields, 13, 14%. Kokta Financial, there is a couple of others. We'll find out about primary issuances in 2, 3 days, but I know that bonds that were trading at 7, 8% are now yielding 10%, 7%. Literally as what we saw prices today. So uh, this is likely to hurt you if you own these bonds directly or if you own them indirectly through funds. Whether so, I don't know the profile currently of say a lot of mutual funds out there. Most mutual funds tend to be concentrated on government securities, which is a big chunk, and then they have some AAA kind of corporate bonds. But credit risk funds are a bad idea right now, is my opinion. I think that's one of the dangerous things. So unless you know what you're playing with, don't play. So okay, I think yeah. Anyone else has questions? Please go ahead. It's been half an hour. Uh, I could close early, but I did want to hear what people had to say. I don't know if I understood anything inappropriately also or incorrectly. But hey, will this have an impact on the LIC IPO? Somebody asked me this. I don't know. The answer is LIC IPO financed? I don't think so, and I don't think financing rates matter at all. But anyway, NBFCs can't finance more than 1 crore for uh, HNIs. So maybe that to that level the financing may come down, but um, I don't. I mean, I don't think LIC will get undersubscribed at least by retail. And institutional subscription will happen on the last day, and they're all very excited about the price. So I think that will go through regardless of what is happening here. Um, and at some point, we'll see some new uh, uh, players. One of the other problems maybe downstream IPOs may have issues, whether it's delivery or one of these things. I think they may have issues because raising money for them, given that their pricing is not attractive, is not the best, not the easiest to get through. Okay, we have one more request. There is Karthikeya. Karthikeya, please go ahead.
That was my bad.
No problem, no problem. Okay, so cool. We have another request. Sharad Shah is back. Sharad bhai, can you hear us? I can't hear you. Okay. Something happened.
Deepak, I had one more question if you're okay.
Sure. Go ahead. I mean, anybody who has this.
Now with interest rates kind of expected to go up, as you said, maybe another 100 basis points over the next 1-2 years, and with some of the consumption names which are usually zero debt companies, do you think that's a good space to be as a sector, not a stock specific?
Yes. So, okay, here's a quick note on this. The reason why I don't like FMCG companies is not because of interest rates, but because their input prices have actually gone up and they don't have a way to raise output prices meaningfully without crushing demand. So, at some point, even a Britannia will have trouble. If my 5 rupee packet had 15 biscuits, I made it 14, I made it 13. You can't make it 3. At some point that palm oil cost has to be translated down. That 5 rupee pack can only become a 6 rupee pack or a 10 rupee pack because it's usually used. There's no way you cannot give up. So the issue is at some point it crushes demand because you make the 5 rupee back a 10 rupee pack, it's not going to sell at all, or it's not going to sell in any meaningful way the same way it is to sell as a 5 rupee pack. So I think the problem there is their input costs have gone up. They are unable to raise um, uh, output prices in a meaningful way without crushing demand. And lastly, they are in a situation where their margins have created their extra high margins in the past and relatively high returns on equity have created PE ratios that are terribly, terribly high. So if you brought their PE ratios down to half, they would still be unattractive from a value perspective. Maybe you'll buy them for quality and good stuff, but that would be at half the current PE. When you have a declining margin profile and your PE goes to half, your stock price can easily correct 40-50%, which is why I'm not excited about these stocks. I'm like, yeah, why buy a stock that is supposed to be a defensive and then it goes and offends you by falling 50%. So an HDFC Bank, which was supposed to be a defensive, has fallen 30%. Many of the high quality name stocks have fallen 25-30%. They're not supposed to, but they've fallen, and they can fall another 25% from here easily. That's why I don't feel. I think companies like IT services may actually be a better bet against this because their demand is relatively inelastic, and they perform some certain types of functions which are very core to organizations. So they don't lose business so much. They will also see some margin pressures, and they've also corrected about 25-30% already, but they are probably more likely to be defensive because their input costs may not go up quite the same. And it's quite very interesting there because their input costs are manpower. Manpower costs went up in the last quarter, but if interest rates continue to go up, VCs and hedge funds will see a contraction. If they see a contraction, VCs and hedge funds may not be able to fund certain companies which are growth oriented but not profitable into their next rounds. Those companies either have to do down rounds, and we are seeing some companies doing down rounds right now, or they may not be able to raise at all and go bust. If that happens, employee costs will come down in the IT sector because suddenly job security becomes a bigger deal, and that will change the margin profile. So if there is actually a problem that manifests downwards, I think IT companies will do better than an FMCG company in general.
Got it. Thanks so much.
Good. Thanks. I have more. Oh, okay, we've got more speakers. So let me start. Gordon, you want to take the next one?
Yeah, hi. Can you hear me?
Hi. Yes, I can hear you. Can you hear me?
Okay. Yeah, absolutely. So my question was, Deepak, with this sort of interest rate, getting increased, this kind of a cycle, how do you see this impacting momentum investing as a factor? And is it, and again, from whatever I've been reading a little bit on Twitter on this topic, is it that value investing is likely to outperform momentum investing? I mean, all other things remaining same, just because the interest rates are going up. Is that what's your take on this? Is momentum investing, how does momentum investing perform generally in a rising interest rate scenario?
Perfect. Sharad bhai, 1 minute. I'll just answer this question and I'll come to you just to this thing. So I think there will always be momentum in something. There will always be value in something, regardless of what happens. Whether if you're speaking whether there's momentum in the market, obviously there is very little momentum in the market right now on the upward direction, which means unless you're a short player, you're not making that much money in this market, regardless of what whether you call it investing or value or whatever. You're not you may be losing less money, but you're not making real money in this market last like a week or so. So I don't think that there is a time when I can say that value will outperform or this thing will outperform. In general, the feeling that teji and mandi that is there in the market is generally on these larger, you know, the top 200 or top 250 stocks. If the value universe is beyond the top 250 stocks, then those stocks, some of those stocks may behave very differently. I remember even 2009, there were some stocks which were going up even when the market was going down. There were stocks in 2013 which are value or momentum. I've seen them in different cycles. You'll find some great stocks regardless of what portfolio. So I think if your approach is a disciplined approach, then you may have to brace for impact for the time when the whole market takes a toss. But the recovery cycle may involve stocks which are in momentum and which are in value in at a higher pace than the market itself, which allows you to build yourself a better portfolio over the next 1 year period rather than to say कि अभी खरीदोगे तो 3 महीने में profit बनेगा. That I can't predict and I don't think anybody can. But I think buying right or buying the kind of stocks you want to buy, you choose the time and you choose the stock, and I think opportunities will come. And if you're disciplined like a momentum strategy, you might end up increasing your cash position if there is no momentum in the market, which will also save you from a steep fall if there is one. So,
got it. Got it. Just a very quick follow question, and then I'll sort of end my question. So basically, what you're saying is that generally, see, if a market is is in a correction phase or a bear market phase, irrespective of whether the interest rates are rising or falling, anyways you would not make much money in a momentum kick. But what you are trying to say is that just because the interest rates are rising, that per se is not going to incrementally be negative for momentum investing on its own.
no, I didn't say that. I don't know whether it will be. We'll know only in hindsight. But whether it is or not, market needs a reason sometimes. It will fall when it has to fall. So whether it is interest rates that fell that caused the damage or whether it is something else, you can't predict. So there's no point predicting whether it does. I can tell you after it does that it's done that. So I know it's a horrible answer to say because there's nothing to do. You just wait. But,
no, nothing. I just wanted to get your perspective on this. Thanks very much.
Cool. Thanks. Mukul next. Mukul, Naveen, and cool. Mukul,
Hi,
go ahead. Thanks, God.
Yeah, hi Deepak. Actually, I was just wondering, what your take on the what would be a terminal rate expectation in this hiking cycle, which India will have. And second, if we assume that RBI is targeting 4.5% inflation, even we assume that we will be having a 6% inflation on an average for next 10 years, isn't it 740 looks to be a good buying for a GSEC yield? Because generally it trades around 150 basis point higher than the mostly above the inflation or your expect or the repo rate. Right now we are trading around 300 basis points. So doesn't it look like the market is over bearish or pessimist about the interest rate hiking cycle? Hello.
Oh, sorry, I was on mute. Sorry. Yeah, I'll answer the second question first. Whether the market's over bearish or whether it is predictive, we don't know right now. What if rates were to go much higher than we expect? So the idea would be, are you comfortable with the 7.5? Yeah, most of us inflation is very different. I don't think my inflation is 10%, 12%. My inflation is very different from anybody else. My inflation is very different because my lifestyle choices may determine how much more I spend. But for the same lifestyle, I am actually not spending more, meaningfully more, in the last year or this year. We're talking about maybe 5 to 7% inflation for me personally for the same lifestyle. If I choose to upgrade my lifestyle, obviously I'll pay more. But food price increase does not affect me in the very least. Even the price increase of um, petrol and diesel, it's such a small part of my overall expense in a month that it doesn't matter. Even if it went up 10%, 20%, 30%, it doesn't matter meaningfully. It's like if I spend 3,000 rupees on a tank full and I have give it to one tank full, 1.5 tank fulls in a month, I'm a 10% increase is the price of a Starbucks coffee. That speaks more about the price of Starbucks coffee than of my this thing, but it's not meaningful to me. So it's very different for different people. So if you look at inflation from that perspective, even 7.5 is a great. In fact, I have bought a very large amount of RBI 2035 bonds, that is the government bonds, from the RBI retail platform at 7.5 because I think 7.5 is a great yield to have. So 7.5 is perfect for, it may not be great for you, but that's fine because it's all individual. For someone whose inflation is 10%, they cannot buy these bonds and meaningfully uh, make money. So, and remember, these bonds are also taxable. So I have chosen them to buy them uh, in in a family account where the tax rate is relatively low, where there's there's no issue of having to pay tax. So I think from that perspective, buying it or not buying it is a good or bad thing from your personal point of view. If you feel your inflation is going to be lower, I think long term our inflation is going to come down substantially from there, substantially from there. In the short term, it may go up, but in the long term, India will also see 2-3% inflation at some point, and that is not because we're a great country or anything like that. It's just that we'll slow down over time. The whole world will, and technological advances will make things cheaper and cheaper on a relatively regular basis, and we will not see that much of an inflation in our regular life. So I think there will be a point at which we see 2-3% inflation. So sticking on to 7.5, I think, is a great idea. In terms of terminal rates, I mean, I don't do a lot of DCF calculations. I look more at growth. So if you do DCF calculations on something that's growing like crazy, you will end up with some ridiculously crazy number. So there's no point looking at it from a DCF perspective. But your DCF value will be what would you pay for a business today? Today, that just gives you a cash yield every year. So whether that is uh, 4.5% or 15% is depend on you. But many people just look at a 15% minimum yield in India. I think longer term India will probably look at a 10 to 12%, given the certain equity risk premium you have to get. Or if you're like at a G level, or not G, well, G is a bad idea, but in many of the US utility corporations, they look at 8%, 9% as terminal yields. So you could use one of those. So it depends on the kind of uh, business you're in and the kind of investor you are, um, and the way you value it. Cool. I'll ask Naveen to get in.
Thanks.
Thanks, Mukul. Naveen, go ahead.
Hey Deepak, uh, can you hear me? Hello.
Hi, yes, I can hear you. Yes, I can hear you. Go.
Cool. So, rupee appreciated with uh, uh, the increase of repo rate, right? So, it will be same for the US dollar also, right? So, whenever the repo rate increases, the dollar value increases. So, what was
No,
the?
no. Currencies trade in pairs. No? Either the rupee can increase or the dollar can increase. How can both increase at the
No,
same
no,
time?
no. Now, see, now we changed the repo rate. After that, the effect was increase in the value of rupee, right? Now,
Uh,
once the
Sorry, it's not. It's not a direct. There's no equation for it. It's just the market traded like that today.
Okay. So how does it now the repo rate will increase, right? So how will it affect the realty sector now? Uh,
Well, interest rates on housing loans should go up at some point. If the government is borrowing for 10 years at 7.5, I don't think people can borrow for 20 years for against a house at 6.5. I think in the end those rates should go up.
and,
Um,
and the reserves which we have means we have so much foreign reserves of USD, right? So if the repo rate in what is the correlation? What happens if US
uh,
rates are?
there is there is no relation. So what happens really is that for forex reserves are what RBI holds in USD. That USD is usually invested in government treasuries, usually short term. So the USD part of it, there'll be some euro, there'll be some Japanese yen, there'll be some other things. They're all invested in each of their, relatively recent currency. That means you may see some invested in USD, 1 year bonds, 3 month T bills, and so on, or in some in euro. So I don't think they invest in 10-year US bonds because I don't think there is that much visibility, or there's a need for taking that kind of risk as well.
Yeah.
So
So
um,
so if you're saying that, then in 2000 and when during 2008 also, the 3 month bond what? So normally yield curve when it reverses, basically if you consider 3 month, 1 year, 5, 7, and then 10 and 30, if you are seeing that, then if it becomes concave, then that means that there is a recession coming in the next 3 months or something. Means in 1990 it happened, in 2008 it happened, before COVID, August 2019 also it happened. So if that
well,
happens,
it's
then
not
what will
always
be the?
true. No, it's not true because you miss the cases when it didn't happen. There have been times of yield conversions where there have been 2 years after which only 2 years later has there been.
I think it's before
Uh,
2000, right? Before, because
no, no,
after
I mean
2000.
after. Yeah, after 2000, even 2004, there was a time in 2005 when there was a 2005 when there was a yield conversion, or 2006 when it took 2 years to hit a recession after that. So it's not 3 months, it's not 2 years, it can be anything. So my funda is this data is usually cherry picked. It's like saying, every time I scratch my head, my stomach aches. Because I only remember when my stomach aches that I scratch my head. It doesn't matter that I scratched my head 100 times. I'll remember that if I scratch my head, last time I got a stomach ache, I was scratching my head. So it's that problem.
Yeah. Okay. 2005. Yeah.
So
2006, 2005. The yield curve inverted. But majority
inverted,
of the
and then
cases.
you got a decision to 7.
So
Yeah.
what
So I mean,
happens?
thing
What
is,
happens to our forex reserve then when
nothing
that
happens. What will
happens?
happen? We have a forex reserve. We'll continue to have a forex reserve. The thing is, whether forex reserve comes down, I think it deserves to come down. We have way too much forex reserve, and the RBI should sell more of its dollars when more dollars come uh, in order to, or when FI is going to take their dollars out, simply because it gives them headroom to buy Indian government bonds, which I think are underrepresented on the RBI balance sheet. So there may be some issues with that, but I then some trading issues with that, but it isn't actually a big deal if we were to lose some forex reserves at this point,
But
or a
our
larger
bonds are
part of forex
illiquid,
reserves.
right? But our bonds are
Our bond,
illiquid.
every bond is illiquid, and every bond market is illiquid. So it's just that the US bond is more liquid, market is more liquid than ours. But when you say our bond market is liquid, what do you mean?
Means compared to whatever US has, I think if FIIs want to exit, they'll be not getting very good rates when they want to exit, right? Means I was thinking from that point.
Rate of what? The bonds or rate of
Means
dollar or
the spread will be too wide. I am thinking like that. I don't know. I don't trade bond market, so
so
I'm
no,
thinking from.
our bond market, FIs are a non-entity in our bond markets. They don't have any. They have less than 2% or 3%, maybe 4% of the market. So they are not a very big deal. They can find their liquid because they'll probably trade in any of the liquid bonds only in US.
Yeah. And MSCI was also trying to include our bonds into their index, right? I think.
Yeah, that is not happening because of a rule India has. So we can't until we solve that technical issue. We're not going to get our bonds in there. Yeah. So, I mean, that will be special bonds anyway, but they will not include them until we fix a certain regulatory issue because we charge income tax on capital gains on bonds to FIIs, which no other country charges. So, therefore, until we reverse that law, they will not enforce it.
Thank you very much.
Yes. Cool. Thanks. Sharad Bhai, you are on. Can you hear us?
Deepak bhai, a scenario.
Hazard. Hazard.
November, coming November, RBI raises rates to 7.5.
Ah.
Dollar rupee touches 84.
Okay.
Then what will happen?
I don't know. आने दो, we will find out.
ऐसा नहीं
Hi.
यार ऐसा.
कहाँ से सर हमको क्या पता क्या होगा आप बताओ why would the dollar hit 85 or 86 it's because foreign investors are selling and RBI is not selling dollars
No.
that is the only reason why it would
One
fall like that
thing
because
for sure, this
हाँ
4.4 or 4.5,
हाँ
for sure, minimum it will be 6 to 7%.
6 is my outer estimate. But that is because of the data. At least from the data I'm seeing right now, they'll raise up to 5 minimum in the next 2 months. I think that's my feeling because that's the way they have 40 basis point कौन करता है? Either they do
नहीं,
25 or 50.
No, but see, if WPA at 15
हाँ
and they say CPA at 7, which is a
हाँ
misnomer. So
नहीं नहीं
suppose
WPI is a problem. It is how the data is. वो base effect का issue है सर. वो last year में base because last year April May was India's COVID destruction time.
वो ठीक
तो
है.
WPI had हाँ वो WPI तब नीचे हो गया था तो इसलिए आज 14-15% है आप 3 महीने में देखो वो भी 6-7% आ जाएगा इट्स जस्ट द
नहीं,
डेटा इज स्क्रूड अप
somebody calculated and
हाँ
said the CPI will be 9%.
इट्स पॉसिबल
So,
बिफोर जुलाई
no, July, August, September, I don't know which one. He said that. So, in that scenario, why 6-7% is not feasible?
No, so my thing is they will get it up to 6, but then inflation will start to come down after that because we are not growing. If our growth was there, our growth was heavy, then I would have said हाँ ठीक है सर वो they want to control. अब growth ही नहीं है मुश्किल से 8-8.5% पे आपका even credit growth है 8
नहीं,
साढ़े 8 पे if your economy
नहीं, but inflation will shoot up and growth will not be there. That is the situation.
exactly no so that's why inflation will come down also because if your
No, I
inflation is
don't think
not
so.
demand
See, inflation is partly international also.
yes and some part of that is dependent on the dollar rate and the crude price so look at crude price look at ruble also no? The ruble has actually which was earlier at 120 130
120.
now it is 67
Yeah,
why should that happen when their interest rate is 20% or 18% or some crazy
yeah,
number like that
yeah.
it makes no sense at all that their currency is appreciated so much so quickly. It's not that anyone is allowed to invest in Russian bonds, but The fact is that they have changed the way their equation is. So some of these market pressures work very differently on the securities. But my feeling is if the only if inflation sustains at 9%, is RBI going to increase the rate to 7, 8, 9, 10, whatever? It will keep on increasing it. But inflation will come even now at $100 to a barrel. If India were to try and reduce the inflation, one of the things that it can do is reduce the taxes. If it were to reduce the taxes to only half the increase it has taken in the last 2 years, that means by 10 rupees or 20 rupees, inflation in fuel by September will be 0%. But I mean, if they basically reduce 10 rupees in the price, वो 92, 93 हो जाएगा, which is the cost it was last September. So
Deepak
if
bhai,
they
always use stars in your eyes, yeah.
no. So what I'm saying is, if they want to control, I don't know if they want to control inflation. But
And
here's the thing: what I'm trying
and
to say is that uh, all
and
doomsday
when you
scenarios
say
are possible.
ruble is at 67,
हाँ,
are you suggesting India starts a war and
नहीं
or
सर, ये कहाँ
or
से? ये तो सर आप मेरे को बोल रहे हो स्टार्स इन माई आईज, आपके मतलब हाउ डज इट गो? मैं स्टार्स मे बी, बट
no
आई डोंट हैव गन्स आल्सो इन माई आईज, बट
no, but jokes apart, Deepak bhai,
हाँ, हाँ सर,
situation is very uh, grim, very
yes,
grim.
it's tough. It's tough. I don't know why they have done this suddenly out of the blue, and
Yeah,
I assume we'll find out soon
yes,
why. So maybe the situation is graver than I thought. I
yeah,
completely admit that.
yeah.
So
And
uh,
jokes apart, things are very bad, yeah. Very bad, very bad.
you're saying in the economy or in world?
चलिए और कुछ नहीं.
Sorry, I missed you there, sir.
हाँ
Sorry, I missed you there. आवाज नहीं आया.
हाँ नहीं तो अभी तो और क्या बोले अब सी वन थिंग RBI is behind the curve. It was
Yes,
amply proven today that they were behind and
correct.
they are still behind.
Admittedly, I think having a 4% rate made no sense when inflation was sitting at 6 in the first
Yeah.
place.
And what is this 4.4 and 4.3745? What nonsense यार 4.5 नहीं कर सकता ये.
नहीं वो हाँ, I don't understand why they have done. The only reason I can think is 4.4, then 4.75. That's the only leap. They wanted to do 75 basis points in two leaps. So instead of doing 50 and 25, they did 40 and 35. They will do 40 and 35. So there will be another one next month. That's my only thought process. So, why else would you do 40? 40 doesn't sound even like a.
माइंड
It's 40
हो
sounds like.
जाएगा.
I hope
Oh,
not. But it can happen.
no, uh, when my increase 5.5 today.
Ha. So I think they've already discussed it, no? 0.5.
And open to. It's very fluid, yeah, very fluid.
I agree. I agree.
You
Sir,
can't.
one more question is there from JRS. वो ले लेते हैं, then we can
Uh,
discuss.
yeah.
JRS, I hope that's your name, but could you take the stage? Jitendra, I think that's what. If you can hear us. Okay. I think
और
that.
किरीट भाई आपको कुछ पूछना है? Deepak भाई, you will make Kirit Mandral as the speaker.
Is he there?
Yeah, he's
I
there.
can't. एक मिनट, मैं ढूंढता हूँ. If फोन पे ना थोड़ा फाइट है, 1 मिनट जस्ट पुटिंग दिस ऑन. नहीं, he is not visible.
Raise hand. Okay.
Okay, strange. He is not visible on. ठीक है. No, I wanted to ask. When you said things are bad, are you saying to Indian economy bad, or because we saw Tata Steel result? I think you had once mentioned that their margins are going to come down quite bad, and you're right. The margins have been horrible in comparison with the December quarter. So, are you saying that in general with India, or now are we?
No, world over, and more specifically to India,
Huh?
this results that you saw of March quarter,
March quarter.
December, yeah, March quarter.
I think I lost you there.
March results came out.
Yes.
So June results will be pathetic, and September will be more pathetic. That is why it reacted like this.
I see. That makes sense. I think uh, markets, and plus we have the US reaction today, I suppose.
Yeah.
So, no, it should have already started. Well, the Fed will come later tonight. So,
I think Samarth wants to say something.
Samarth, 1 minute now, Samarth.
किरीट भाई को ले ना.
मैं आपको को होस्ट बनाता हूँ, आप उनको बना दीजिए, मुझे दिख नहीं रहे हैं. And I can't see Kirit Bhai, and you said Siddharth, is it? No.
Yes, I'm a co-host.
If you can invite him, because I can't see him.
Yeah.
Okay. RBI actually mentioned a few things. One thing that they mentioned was they're afraid of the market crash. Oh, Samarth is here. Yeah, Samarth, please go ahead. Kirit? We can't hear you. If you're using a headphone, can you please use the handset? Hello.
Hello.
Can you hear me?
Yeah. Am I audible?
Yes, now you are.
Yeah.
Sorry, who's this? Because I think.
Yeah, Samarth.
Samarth. Now you can.
Yeah. Actually, a few years ago, there was this DHFL crisis done by the bonds issue was there. DSP Merrill Lynch was there. The seller was not there, but the buyer was not there, and the bonds yield went up. So, any crisis like that happening in mutual fund industry? Do you think anything like that? They are holding high yield bonds.
Yeah, actually, see, that was not a big deal. DHFL bonds were already yielding 10%. DSP did Hemendra Kotari had to come on TV also at that time. They did a trade at 11%. 10% से 11% में कोई ज़्यादा फर्क नहीं है. But people got psyched, and then that caused, the problem is DHFL was rated AAA. Everybody thought ये AAA bond को mutual fund has sold at 11%. Why? But DHFL and ILFS bonds were always trading very high yield. Nobody trusted AAA उसमें. today also I'll tell you that for the last 6 to 8 months I have been saying this. Edelweiss and India Bulls housing finance bonds have been trading at 9, 10, 11, 12. In fact, recently even more than 13%. Both have traded. They are trading even today. I think Edelweiss traded at 13%. I don't remember today, so I had a little bit earlier. I don't see, I don't know India Bulls, but today a lot of bonds have traded about 10% yields. I'm talking 8 year, 9 year, 10 year, 6 year bonds. Today, Quadrillion, which is this slice company, I think they own this company called Quadrillion. उसका दिसंबर का बॉन्ड ट्रेडेड है 13%. दिसंबर 2022, 6 महीना हो रहा है. And this is some VC funded company and all that stuff. Their bond traded at 13%. So it is happening, but I don't know which one will trigger anything.
Deepak sir, I am saying mutual funds, bond schemes are holding these high yield bonds, double A rated and single A rated. They are having that in the portfolio. All these income funds and this debt funds, what you say. So, like this Templeton issue was there, wherein they had to close down the schemes, so and they had to stop redemptions also. The redemption pressure was there. So, cascading effect would be there. I suppose it would be there in the near month.
See, it's not, yeah, I mean, the thing is, mutual funds have learned from that exercise. So they keep a lot of liquid funds available for liquid securities available, like government securities, so that redemptions can be handled. But still, I would say credit risk funds will have some issues. And India does not have what are called vulture capital. It does, like, for instance, I cannot set up a company and say, yeah, I will buy this bond at, say, 70% discount or 80% discount. That if
Junk
you want to
bonds,
sell
junk bond.
desperately, you don't. Junk
Yeah.
bonds. These are actually not junk bonds, these are called distress bonds. So the distress bond market India is zero, which is why if there is distress in the market, nobody will buy. So our, the very few companies that, all the distress buyers in Indian markets are FIIs. They are the only ones who set up distress kind of buying, proper distress buying market. So I don't think this is a big problem. There's a big market. So right now, I don't know. I mean, I'm not seeing anything of that sort happen, but we don't know how it will kind of progress. I hope it doesn't come there, but right now I'm not seeing anything that is.
Thank you, Deepak sir. Thank you.
Thank you.
Yeah, hi Deepak. Can I ask you a question?
Yes, Kirit bhai, yes, sir.
Deepak, you are an expert in bond. You are famously known as Bond Baba. So just want to rack your brain. See, globally there has been inflation problem and interest rates are going up. So couldn't it be looked at that this was in the offing? And probably the way the markets have been holding so far in comparison with the global market, we haven't actually gone back to the level that the markets have seen when the war broke out. So, do you believe that this was already in the offing and it's just an overreaction of the market? Or you think the markets are further downside? I know it's difficult to predict the market, but just your view.
Yeah, no, so I think, see, markets are showing a downtrend. There have been three, this is the third higher high, and if it goes down below 15,600, it will be a third lower low as well.
True.
So this is a definite downtrend. So there is volume on the downside. There are stocks which are even now quite heavily overvalued, and therefore if they corrected 30-40%, I would not be surprised. Having said that, I think the market structure has changed now. Earlier it was FIS selling, retail buying. Now it's possibly both retail selling and FIS selling. Because to a certain extent, the alignments of buyers have gone away. We're going to see in brokerage numbers, I think numbers will come out by the 7th, that the additions of new accounts would have slowed down in all of the top 5 or 6 brokers. So there is the liquidity problem that gets exaggerated when markets fall, because if you're not getting new buyers and markets are falling, then current people start selling heavier in general. Liquidity changes cause market to fall more rapidly than a fundamental driven fall. So fundamentals may drive stocks in the longer term, but in the short term, it's always driven by liquidity. So right now, what we're seeing is a lot of liquidity that is going out both from retail and foreign investor markets. We might actually see foreign investors turn buyers before retail investors get back into the game. They will be they're likely to become buyers because they've done a lot of exhaustion based selling in the last 6, 7, 8 months. And India is relatively, from an economic perspective, relatively less affected than the West. And many other countries. I'll tell you why. For instance, you can't invest in China. You will not be allowed to invest in Russia. Brazil is actually a very good investment, but it's a commodity-based investment and it's a cyclical. So when their cycle turns, they will get impacted badly, and they relatively have much higher inflation levels than India also. So you have very few large economies that you can invest in meaningfully. Though I think China is a threat here because China can change themselves and become investment attractive very, very fast. They have size, which is a huge factor compared to India. So in that context, I think India may not be such a bad place for foreigners to invest in if we were to correct meaningfully. We haven't corrected meaningfully. So we haven't even fallen 10% from the top.
True, very true, very true.
So I think we're still struggling. We're still about 9.5% from the top. So we should fall a decent 20-25%. No? So then we can say. So I think we should give ourselves that key. At least another 10-15% will fall
But
as a market.
correct. But just a contra view, there could also be a reason that if things have fallen about 18-23% and we are still at 10%.
Oh, sorry, you said 18-23% and no more falling. Is it?
No, I'm saying globally, if we compare, we are just 10% down from the peak, right? Whereas the global, yeah, can you hear me, Deepak?
Yes, go on.
Yeah, my question is that globally markets have fallen much more, whereas we are just down 10%. So can't it be looked upon that why is that we have only corrected 10%? If we consider ourselves to be part of the global market, then we should be in tandem with those markets, but we've fallen much lesser. So is there a surprise element that is holding the market, or is the surprise going to be on the downside?
Right now, good question. I can think of reasons why we have been less affected is because our market didn't get. See, even if you look at how much oil prices have risen for us compared to Europe, Europe costs have gone up 20, 25, 30%.
Correct.
India costs have gone up maybe 10-15%. So, that way, relatively, we are less impacted from a fuel price perspective. Our food prices have not actually gone up. Vegetable prices have actually come down. From a relative basis, compared to December, relative vegetables are cheaper today. But that is also, it's a seasonal. It just seems to happen, that our cycle is harvest in December, January, comes to market and then brings prices down for the next 2-3 months. This is the major elements of our inflation. The rest of the inflation is borrowed in the sense, if it is a computer, it's the import price of the computer. If it is a car, it is the price of metal and steel and all that stuff. And those prices have gone up a little bit, but comparatively in the West, the prices have gone up a lot more. So their input cost pressures are much higher than in India. I mean, relative speaking. So, having said that, I feel India is relatively has been a slightly better play. The best market to invest in USD terms would have been Russia if it was open.
Correct.
It's not open right now, so I don't know what that thing is because the currency is appreciated. India relatively, I think, has done better because of these factors. Despite the FIS selling so much,
precisely,
it is strange that the US dollar has remained exactly where it is, and that could be because of two reasons. One is we have a counterbalancing impact from relatively higher exports in comparison. Since the deficit is not rising, but the deficit is so it can't be the export thing. Yeah, or it can be higher service exports, which is of the order of $1 billion a month. It is not significant there. Or it could be on the aspect of FDI investment continuing to be high, which has been true because a lot of startups and a lot of companies have been putting in more money into India. And that has been countering the effect of foreign portfolio investors exiting. And then to balance it out, RBI has been selling dollars. in the last 3 or 4 months. So I think of the order of maybe 70,000 to 80,000 crores RBI has sold. So 10 to 11, 20 billion, $15 billion they have sold, and they probably will sell another 10 to $15 billion more. It's just the nature of the game. They have they have an excess amount of dollars that they've got in their balance sheet. They need to sell it, and it's a good time because if FPIs are selling, exiting, they can sell it in the market and so on. So, given this, I think the Indian equation is kind of. So, what happens from now on? Does RBI still have room? According to me, RBI still has room to sell. FDI might slow down towards the end of this year as the interest rate cycle changes in the West. FPI might not be selling as heavily as they sold last year. So, in my view, the dollar will still be more or less stable. I mean, unless RBI decides to forget it, yeah, everybody else is destroyed, so we'll also destroy our currency, or let our currency go down. Other than that, I feel that the currency should be relatively stable, and if that currency is stable, then eventually a lot of good things will come back. But market could easily correct another 20%. I mean, there's no reason why. In the face of a worldwide liquidity problem, India will not be an innocent bystander. हमको भी चोट लगेगी.
बिल्कुल 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 बिल्कुल. Thank you so much for the response, Deepak. Thank you.
Thanks, Kiran. Bye. Okay, Vishal, sorry, you've been looking to speak for a while. Vishal, go ahead.
Thanks, Deepak ji. Deepak ji, I have a simple question on the food inflation piece. Now, given that I was listening to the entire conversation, you have a view that the food inflation will come down over the next 2-3 months. But if you look at the entire agri space, what has happened is, especially on the rabi crops are trading almost 15 to 20% at the premium from what they were trading last year. I mean, look at wheat. Government is running short almost of 10-15% of their targets on the wheat procurement. Mustard, the oil seed prices are skyrocketing. I mean, with the now palm exports being banned from Indonesia, it is again a big problem. India is the largest importer on the palm side, and now next we are the kharif crop which comes in, which starts coming in September, October onwards. The input costs, especially the seeds, fertilizer costs, have gone up drastically. Now, looking at this, what actually is happening on the rural side is that the disposable income on the ground is coming down. I mean, the credit growth on the rural side is not picking up, and especially the margins, the net margins on the ground side, people who are on the agri piece, the margins are diminishing. So where do you see what happens if tomorrow the food inflation doesn't come down and the prices continue to remain on the top side, on the higher side? How do you look at it in that case?
Yeah, food prices will go up. I think next 3 months at least we are seeing food prices going up because of a base effect also last year. So food prices, like you said, fertilizer costs and input costs are higher. Palm oil imports are stopped, but palm oil imports I think will come back in 6 months. So I don't think Indonesia can sustain that long without having this. And that too, they've stopped crude palm oil. They've stopped only some. No, they've stopped refined palm oil exports, but they're continuing to allow crude palm oil exports. As I remember. So crude is what we import, crude palm oil, and then we refine it. And then there is a bunch of other things. Of course, the palm oil prices have still gone up. It's not like it has come down, so it is still going to increase costs. And there is also availability issues in terms of ships. So you don't get enough ships to get stuff here. So you can't import, and therefore you have to pay a higher price. So in the next 3-4 months, I believe food inflation will be a problem. Which is why the next 3 months, I think inflation will go very high. Also, it's not like it's this thing. Food inflation in India, however, in the longer term, will come down. Now, wheat procurement coming down is actually good for India. If they don't procure, it's a fantastic thing. Because that means the food will, I mean, if the government is not able to procure, that means farmers are not selling. That means they're getting other markets to sell it. If they are getting other markets to selling, that means either that market is for export or for this thing, because it's good, no? Because we have excess. We don't need to procure so much. We have 3x or 4x the amount of buffers we require because we have procured so much in the past years that we don't need to, but we do it because नहीं तो farmer बेचारा जाएगा कहाँ पे. But इस बार world prices are higher, so they can actually sell abroad or sell in the market for a better price. So lower procurement means that the government will have 50-60,000 crores less to spend on procurement from the farmer, and the farmers will then be able to, of course, their disposable income may change because some farmers will be less, some farmers will be more. But for the most part, procurement happens in 5 states only, that, and they are not India's 50% also of the farming community. So procurement is largely about 5 states, and those 5 states, for the most part, uh, are some of the relatively richer farming community in India. So I don't think that is going to create massive amounts of farm level distress. But there is, I think one of the reasons why it's not happening is not because of less production, but it's because of better alternatives to the MSP that is available um, for the government. So I think that way, food inflation, while it will be
Deepak
high
bhai,
for the next few
sorry,
months,
sorry, but especially on the wheat side, with the extreme weather conditions this time around, extreme heat, the crop has been destroyed a little bit, and the yields have come down, and that is the whole reason why there is a shortage of. The number is at least, if not more, 10% down than what it was last year. Now, my second
last
question
year
is,
was also extremely high. Yeah. Last year
yeah,
was extremely high. So 10% would
yeah.
बनता है ना यार. We had a much higher yield last year.
सर मेरा एक सवाल आपसे ये है कि आपने
Hmm.
बिल्कुल सही कहा कि सरकार नहीं खरीद रही है एंड द फार्मर्स आर सेलिंग इट टू द प्राइवेट प्लेयर्स now given that now let's say ideally if there is a scenario where the global prices shoot up and government has nothing in their hands to control the prices where do we go I mean how does the common man I mean अगर आज गेहूं 25 रुपए हो गया which was quoting around 18-19 rupees last year or sugar starts trading above 40-45 rupees where do I mean what happens to the disposable income of common man आगे
No, no. I see. Let's put it this way: the government has PDS for that only. No, it is the PDS that keeps the prices low for people who cannot afford it. It is above that where prices go up. For people at higher economic strata, food is a much lower part of their cost ecosystem. So your gehu ka price will affect a person who's not buying in PDS. It will affect the corporate, it will affect the biscuit producer and all that. But it will not affect the guy who's trying to buy from ration shop because ration shop ka price wahi hoga. So I don't think there will be massive distress on that front, but yes, of course, some disposable income will come down. There's already a problem. It's not like it's not a problem. Today also, incomes have not gone up. The rich have gotten richer. The poor are screwed last 2 years. The divide has massively widened. How much more do you think the government has earned? In the last 2 years, the government has earned a massively higher amount of money. I mean, of the factor of 40% more than pre-COVID into 2022 versus 2020, which is just before the COVID hit us. We have seen individual income taxes go up by a run rate of 20% a year in the last 2 years. That means the rich have just gotten richer, the poor have gotten poorer, and they're already screwed. So ये disposable income नहीं होने वाला चीज ना already हो गया है. So now some of the richer people may actually have issues, which is why there will be a possible correction, I think. But I don't think this food inflation, um, you know, uh, I mean, I want to wait to see. I don't know how bad the situation is, but if the situation isn't as, I mean, is reasonable, I think food inflation will, correct itself by September, October. But again, a lot of ifs and buts there.
Deepak bhai,
right right sir thank you so much for your insights Deepak bhai let's keep our fingers crossed that we don't have a distress on the food side food inflation
I hope
thank
so.
you
I hope so. Yeah. I mean,
yeah
I don't want people to die eating for not having. I mean, for not having food to eat.
I mean we don't need a Sri Lanka in India happening
नहीं, वो मुश्किल है. But हो सकता है. I mean, I don't know.
thank you
Yes.
thanks Deepak
Thank you. Thanks, Vishal. Shazba, you're back. I think we've run out of. Have we lost anybody on speaker? I think everybody has spoken. So I think काफी लंबा हो गया. So I think we should kind of close this out. My closing comments are, interesting thoughts here. I think We do have views that inflation may go up much higher than expected. When you take a look at what RBI released something yesterday, I haven't gone through those. There is also the fear now that the world will also, increase rates very dramatically. So that may affect India in a very big way. Um, Stock markets, of course, I don't know what the answer to what will stock markets do is, but it doesn't look nice for stocks in general. There will be margin pressures, there will be potential defaults, there will be increase in costs for NBFCs and for credit in general. So the capex cycle will slow down or will not even start. I think it started at all. Um, so, having said all of this, I think the next, uh, uh, I'm still optimistic that India will come out of it relatively better than the West. But, you know, India sometimes is a victim. Uh, Sometimes वो ये होता है ना वो uh, sometimes this is a match you snatch defeat from the jaws of victory. We have done this many times, so uh, it's possible we do this now also. I won't get political on this, but that's how governments are. Sometimes they're just stupid, uh, stupid decisions. Politically, when economically they could have been made better decisions, but I hope that doesn't happen. And I'll kind of close this at that. Thanks so much for all for joining in. This was a great session so late in the evening. Gives me a lot of ideas for what I want to write about. So thanks so much. And this will be recorded, so if you can come back, if you want, you can come back and check what we've said. Um, Thanks a ton to all the speakers as well. And thanks all for listening.